Understanding financial statements. Let's talk about balance sheets. Follow my video and I'll explain more. If you haven't yet, click the bell and subscribe to be notified every time we produce our best pieces of content. Let's dive into financial statements and let's talk about balance sheets, because you're not alone if you don't understand this area. A profit and loss is a bit more logical where you've got income versus expenses, but let me talk about a balance sheet to help you give the top line of what you need to understand this statement. What is a balance sheet? A balance sheet in layman's terms is the same as taking a picture where you go at an exact point of time. Normally this will be at a month end, and normally this will be when your financial year ends. And all it is doing is listing all of your assets and liabilities to get down to either a positive balance sheet, which means you've got more assets than you have liabilities, or a negative one, which is the other way round. At the top of the balance sheet, you normally start with fixed assets. And fixed assets are any asset that would normally last for more than 1 year. Let me give you some examples. A property would be classed as a fixed asset. Computer equipment will be classified as a fixed asset, and also furniture and fittings. There are more other asset classes like motor vehicles and vans, and they will all form part of your fixed assets. The majority of assets will be depreciated over their useful life. That basically means if you think a laptop or a bit of computer equipment is going to last you 3 years, you would reduce that by a third. And each year you would put a third of the cost of the laptop into your profit and loss account until it gets down to zero. So by the time that you get to the end of the 3 years, the laptop's worth zero on your balance sheet, your laptop's worth a bit of scrap value, and you're reducing it over its useful life. The same could be with fixtures and fittings, the same could be with plant and equipment, the same could be with motor vehicles, and the same could be with vans. You are literally going to take that asset and go chop, 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 and put that cost into the profit and loss account over its useful life until it gets down to zero. The one asset that very rarely depreciates is land and property, because most properties appreciate in value. So your top line of your balance sheet are going to be what is the purchase price of your assets less any depreciation. The next part of your balance sheet is going to be current assets. And these are going to be any assets that you've got that are worth money. Now, the first, most obvious one is any cash at bank. Cash at bank is going to be an asset within your business. You would also then look at other assets will be how much do your customers owe you at any given time, any prepayments, and also any intercompany loans. I could reel off lots and lots and lots of debtors and assets for a balance sheet. For this video, I think it's just going to be too long-winded. The next part of your balance sheet is going to be creditors, and we normally define creditors as what you owe different organisations and or people. So, and you would normally classify these as payable under 1 year and payable over 1 year. Let me start at under 1 year. Classic examples of liabilities are trade creditors, what you owe your suppliers at any given point of time. Also, you will have amount that's owed to VAT, because you will accumulate VAT every quarter and pay it over 4 times a year. You will also have PAYE if you've got team members that are employed, where you will pay over their PAYE once a month in arrears. You may also have credit cards as well, and credit cards are a really neat tool. You can basically get interest free for 30 days until the next statement for them to be paid. So this is a combination and some examples of creditors that are normally defined as under 1 year. Now, you would also have creditors that may be payable over 1 year. The classic for this can be a mortgage or basically an HP agreement that you may have on a car or a van. So if the segment of that loan is more than 1 year, you would reclassify that in a slightly different position. Ultimately, it still comes off the assets less liabilities equals net assets, but I think it's really important to define this, because you then know from a cash basis how much you would need within your business. Now, if you take the sum of all these will equal normally your share capital, which is the shares that you've issued with your business, and the shareholders of the business own the business. A common mistake that we come across with a lot of small business owners is they think the directors own the business. It's not, it's the share capital. And also you will have a cumulative total of your profit and loss account. So, and this will be from day dot. So if from day dot you've earned 100 grand that's been retained, you haven't taken it out as expenses, you haven't taken it out as dividends, your 100 grand plus your share capital will equal all your assets and your liabilities. Now, one thing to beware as a small business owner is most small businesses that are run at the minute are undercapitalised. That means that they're underfunded. They've been treated as a lifestyle type business, which all the profit has been taken out and there isn't enough capital to actually support the business. So if I had to change one thing about small businesses in the UK, that would be I wish a lot more of them would be more capitalised. My question to you is, how well do you know your way around your balance sheet? Is your data kept up to date, or are you doing it basically on a VAT return quarter, or are you doing it right at the year end? And how much of your balance sheet do you really understand? Is there any debris sitting in yours where there's either mistakes or just old stuff that may need to be written off, or you just do not understand? And also, how well capitalised is your business? Have you got a balance sheet that's strong, that could get you through some tough times, or are you sailing really close to the wind and playing it really tight? I hope this video's really helped, and if I can help you with any further questions, click my link below. This will allow you to book a discovery call with me. This can be up to 30 minutes. I'll take on board any questions that you've got, and I promise there'll be no pushy sales pitch. And also below, I'll leave a copy to our book, which is called 74 Ways to Pay Less Tax. This is a way that in one booklet that you've got 74 opportunities. So how many opportunities are you currently taking within your business, and how much tax could you save with the ones that you're not? Please download this book today. Enjoy.